Ramang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Ananth Narayan, Professor Finance at SPJIMR, joining in. Welcome to the show, Ananth, and a pleasure to speak to you as always. My first question, Ananth, coming to you is with regards to where the CPI number goes at 6.95%, which is much higher than what the consensus estimates was looking like as well. And to add to that, if you see the inflation with regards to rural India is much higher as compared to what we've seen in terms of urban India. What's the sense that you pick up?
Well, first of all, thanks for having me again, Hiral, and great to see you again. Yes, CPI is looking worrisome, including in the subcomponents of CPI as well. I think the things which have changed dramatically, Hiral, is one is, of course, crude oil prices. That's been on upswing ever since the beginning of the year, and particularly after the Russia-Ukraine conflict began. RBI now is penciling in $100 average price for the Indian basket over the next fiscal year. If that alone was to pan out, and if you add to that other commodities like edible oil, like agricultural products, like feedstock, like chemicals, fertilizers, again, a very, very big component which goes into our agriculture. If you add all of that, then it does look like the trajectory going forward for inflation is still looking very, very high. And this is despite the global slowdown. You've seen IMF and World Bank bring down estimates for global growth. But a combination of supply chain constraints, including in coal now, and high commodity prices, means that inflation over the next 1 year could actually average well over 6%. In fact, I would not rule out the possibility that it averages 7% over the entire fiscal year FY23. I'm not saying it's a base case, but I'm saying it's a non-trivial risk that inflation could remain very, very high for the time being. So it is definitely a worrisome trend for the time being.
Right. So Ananth, with this kind of a number that's coming in as well, as you mentioned, there is a possibility that we shouldn't be surprised if we even go to that 7% mark. Do you think there is a possibility of a change in RBI stance to come in? And if so, what could that look like and how many rate hikes can we envision? Because the market was pricing in around 50 basis points rate hikes so far, and now the numbers are changing.
Yes, Hiral. So in fact, the market is pricing in about 200 basis points over the next 1 year. So the 4% repo rate is supposed to end at between 6 and 6.5% if you look at the OIS curve currently. Similarly, if you look at the 10-year bond yield and the shape of the yield curve, we are pricing in about 7.75 on the 10-year bond yield over the next 1 year. So yeah, the market is pricing in a lot. Now, I do think the RBI will be forced to respond, given the fact that inflation estimates are looking very, very high. And at the same time, it's not an easy policy context at all for either the RBI or the government or the MPC here. Look, the MPC has a very simple mandate. It says control inflation and keep it between 2 and 6%. And it has offered only one tool to the MPC to do so, which is using the repo rate. In reality, the notion that you can control inflation by using just the repo rate is utter rubbish. No person can actually prove that that is possible under all circumstances. Certainly, it's not possible under the current circumstance. But nevertheless, given that you have to maintain credibility, you don't want to be seen as being behind the curve, and this is the only tool available to you, RBI will have to react. But think of the entire package, Hiral, as if you were the policymaker sitting inside RBI, what would you look at? Growth is looking tough. Okay, RBI has already brought down the FY23 estimate to 7.2%. And by the way, that is under threat if global slowdown continues and pushes down our exports, and if the rise in commodity prices continues, right? So it's a very uneven recovery so far. We are barely where we were 2 years ago before the COVID crisis began. Unemployment is still looking very, very bad if you go by CMIE numbers. So growth is a problem. Unemployment is a problem even today. Inflation at the same time, as we all agree, is looking very bad. Okay, hopefully commodity prices come down from here, which will be a saving grace, but otherwise it's looking pretty bad, right? Now and the global context, by the way, is also not looking good, which means even on the currency side, we could see some pressures. We could see more outflows than inflows for the next couple of years. So if you see these constellation of factors, it's not an easy context at all. There is no ready-made answer available. Okay, personally, what I'm hoping for is the RBI does not rush into too many rate hikes in the short end right away. Instead, I hope they allow the longer end yields to move up in line with the large borrowing program that the government is going through. And I'll tell you the reason for that. See, short-end short-end repo rates and short-term money market rates, raising that makes sense to control inflation if there is a lot of credit growth underway. So if lots of people are borrowing money for buying houses, for buying personal goods, then hiking interest rates to control credit growth and to control money supply and to control aggregate demand makes sense. Yeah. So if you remember in the mid 2000s, we used to have 25 to 30% credit growth. Yeah. At that time, Dr. Reddy would hike rates precisely for this, to try and control the rate of credit growth. Right now, we are barely seeing 7.5% credit growth over a 2-year period. Over a 1-year period, it's 9.5%, but over a 2-year period since COVID began, we are barely at 7.5%. That's lower than your nominal rate of GDP growth. In such a context, to argue that hiking repo rate will bring down aggregate demand is not really tenable. You really can't justify that thinking. It does help in sentiment. If you want to show that I'm doing something, it does convey something. Otherwise, in reality, how it will work out is not very clear. On the other hand, if you allow the longer end rates to go up, look at people like you and me who have some savings, thanks to God. Right now, you're putting money at 5% fixed deposit rates in banks. That's the average fixed deposit rates. When the households expect inflation at 11%. So if you have such sharp negative real rates on your deposits, you will not put money in deposits. You would rather put money in equity markets, maybe into real estate, maybe into Bitcoin, maybe into foreign markets through the fund of funds. So those are the routes that you prefer, right? There, if you and I can be offered 7% return for our risk-free or very low risk fixed income instruments into 5 years, that actually reduces the amount of money going into asset markets, that reduces the amount of money lying waiting to be for consumption, and it reduces things like gold imports. Last year we imported $50 billion of gold, a record number for all times. So to me, the way to address inflation currently is actually the longer end yield curve, not the short end so much. Now, I'm not sure if everybody will agree with me, particularly policymakers, but if I put myself in the MPC, 10-year yields are not in the MPC's hands, unfortunately, the way the construct is right now. So the only thing they can touch is your repo rate, and that's probably what they will end up doing. So will they go up to 200 basis points? I don't think they will. I think the RBI will be concerned about the fiscal deficit of the government, funding the fiscal deficit and of growth as well. But yes, some amount of rate hikes, I think, will be penciled in. I'm guessing they will probably do 100 basis points of rate hikes over the next 1 year.
Right. So with that number, do you think it's going to be as aggressive? Because there is growth concerns which are lingering, one. And the anticipation is that probably the environment of negative real interest rates will sustain in FY23. So how do you really gauge that situation?
Sure. Look, a lot of it is going to be data dependent. Okay, we've seen a fair amount of volatility in commodity prices. Not too long ago, it was $130 a barrel for Brent crude. It came down to below 100. Now it's about 107, 108. So it's been extremely volatile. Now, by the way, the futures project that they will come down below $100, and over the next 3-4 years, it will come down below $80 also, right? I hope to God that's true, and I hope that plays out. In which case, frankly, we don't need to worry too much. It's a bit of, we have to grit our teeth for a while, and then eventually things will sort themselves out. So it is going to be very, very data dependent. If crude oil prices do rise from here to 120, 130, 140, RBI will have no choice but to act more. We can argue about whether it makes sense or not, but they will have to demonstrate that they're doing something. On the point on growth, look, some parts are not in our control. For instance, we don't know how global exports will look like because it depends upon global growth, etc. Likewise, some amount of growth is also impacted by commodity prices. In fact, the RBI's monetary policy report, the MPC's monetary policy report for April, says that if there is a 10% hike in crude oil prices from the base case of $100 per barrel, it will bring down your growth estimates or growth numbers by about 15-20 basis points. That's the sensitivity that the RBI has penciled in, right? So it is going to be, those things we can't control. But where we do have some control is on all the reforms that the government has been planning, whether it's pushing money into infrastructure investments, whether it is making ease of investments better, right? Labor law reforms, they've already cut tax rates, etc. Third is things like the PLI. I have a lot of hope for things like PLI. Fourth is privatization. That could trigger a bit of growth and employment as well. And finally, lots of sectoral reforms, including in power, financial sector. Those things can make a difference to our growth prospects with monetary policy. Nothing to do with the global markets, but these things have a good chance that we protect the growth. Now, the short point being the ability of monetary policy to actually support growth is kind of limited at this point in time. A lot depends upon government policy, upon the fiscal side, and of course, the private sector responding in kind to the incentives being given by the government.
Right. So with all of this, as you mentioned in terms of credit growth as well, Ananth, yes, we are in single digits, but the anticipation is that it could be in lower double digits in the coming year. Do you think that is a possibility and an easy possibility, or do you think that's going to be something difficult to attain?
Oh, I think it will happen. I'm reasonably sure we will see increase in credit growth for a couple of reasons. One is, as I said, for the last 2 years, we've seen no credit growth at all. So some amount of catch up has to happen. Second, we don't know if COVID is gone for sure. So fingers crossed on that. But as of now, at least with all the restrictions easing up, we are seeing contact-based services coming back, right? People are traveling, hotels are getting filled up again. Airports are chock-a-block. So hopefully that continues. So as services comes back and as activity improves, the demand for working capital and hopefully for investment subsequently will also come back eventually over a period of time, right? Third thing, more importantly, is if everybody is convinced that rate hikes are on the way, maybe that triggers a requirement for people to take housing loans or for corporates to borrow some money and keep it aside, thinking that anyway interest rates are going to go up. So all that is possible. I think borrowing will go up, and it's good for the country if it goes up. I wouldn't be too worried if it goes up to 12-13%, credit growth, right? Our nominal rate of GDP growth this year was 19% here, right? For next year, while the government has penciled in 11.2% or so, I think it will easily be 14-15%. So credit growth lower than the nominal rate of GDP growth is not really a cause of worry. I wouldn't start worrying about it. Where I would start worrying about it is if it goes beyond 15% or so. If it goes into the 15-20% rates, that's where you can argue that monetary policy has a bigger role to play. So, my point on repo rate hikes is that watch that credit growth number very closely. If it starts to cross that 15%, that's when you need to trigger sharper rate hikes, repo rate hikes, not when it's at 9-10%, not really, not the point in time. Okay. Now, does this do enough for growing the economy? Lots of things have to happen here. Just because of credit growth, we will not see the growth itself, the economy itself growing. The other things that I mentioned in terms of reforms, private sector, etc., has to also come in place.
Right.
A warning for people.
Yeah, go on.
Yeah. I was saying that on this credit growth, a lot of loans that have happened over the last couple of years, Hiral, are actually linked to repo rate. People think it's a 6.5% mortgage rate for many years. It's not. It's a 1-year repo rate plus 2.5% in many cases. As repo rate goes up, actually your borrowing cost will go up, and borrowers are going to face that risk at some point in time. Sorry, please go ahead.
Right. So with all of this said and done, another two important factors that we need to consider is the current account deficit and the fiscal deficit. Now, if you talk about the current account deficit as well, it actually widened from a 1.3% of the GDP in the second quarter already. Secondly, if you go to see what is it that you think we should be penciling in, and how do you think the balance of payments, etc., will come into play?
Great question. So let's quickly look at the balance of payments. Look, let's start with the current account deficit. We import about 1.4 billion barrels of crude oil for our domestic production. Okay, so if you, and this is a net number, we also re-export, but I'm saying this is a net number. So if you have crude oil at $100 per barrel, your total net crude oil imports is going to be about $140 billion. That's one number which you can't do much about. Okay. There's also the added item of coal imports and so on and so forth. I won't get into that, but a big chunk is this, right? Now, our non-oil imports, the last year for FY22, for fiscal year 22, was about $95 billion. Okay. Unfortunately, the trend, even in non-oil imports, principally because of gold, etc., has been going up, right? So if that trend continues, we could well end up seeing our total goods trade deficit at about $250 billion, which would be a record high. This year it was about $190 billion. Okay, so FY23 could see a sharp increase in the goods trade deficit. Now the good news there is our services exports are doing very well. So services plus remittances, what we call invisibles, is at an all-time record of close to $150 billion this year. It could hit about $160 billion next year. Even with that, we could still end up with a current account deficit of $90 to $100 billion, which would be about 3% of GDP. That's not a healthy number. And by the way, it's a very risky number. If commodity prices increase, if coal prices go up, oil prices go up, fertilizer prices go up, it could easily go to 110, 120 as well. So that can't be ruled out. Now, on the other side of the balance of payments equation, on FDI, unfortunately, our net FDI has been kind of plateauing over the last 3 years. It's between 42 and $44 billion. This year is looking slightly weak. Okay. So even if I take $45 billion as FDI, around $100 of current account deficit less $45 billion is about $55 billion of deficit still, right? Now, what is left is portfolio flows. Since October of the last year, we've seen $22 billion of portfolio outflows. Okay. Now, we don't know how things will look like going forward. Some are saying, "Bahut nikal gaya hai, iske baad nahi jayega." Who knows? I mean, the markets are still very, very volatile. Even if I assume zero portfolio inflows and outflows, we are looking at $55 billion of net outflow. It's not the end of the world. Okay, we have $670 billion RBI has got across reserves and forward purchases. So total buffers, they have plenty. They bought $200 billion over the last 3 years. Okay, but if the same circus continues for 2 years more, where we lose 50, 55, $60 billion for 3 years, then suddenly the level of our reserves as a proportion of our GDP will come back to where we were in 2013, which was not a good time at all. So the point I'm making is a lot depends upon how oil prices, etc., develop from here. If they remain at current levels, unfortunately, we could go back to the bad days of 2013 in 3 years' time. The good news, we have plenty of time. It's not there's no crisis immediately. We have plenty of reserves for now. But over 3 years, things could get bad, which means we have to get jobs, output, and exports up in the next 3 years.
Absolutely. And with that, if you see in terms of the borrowing program as well, we are pegged at around, say, 59% of the budget in the first half of FY23. What do you make of that number as well? Because clearly, again, the kind of impact it could have on the 10-year bond yields, one. Plus, if you talk about the spread of the issuances across tenors as well, we have only 20% concentrated in the 10-year. That could probably provide some bit of respite as well. So how do we see that equation?
Again, great question, Hiral. So very quickly on the fiscal side, I expect some good news actually here. So if you see the tax collections which came in for fiscal year 22, it's supposedly at 27.07 lakh crores overall gross tax revenue at the central level, which is a record high. And by the way, significantly higher than the revised estimates as well, right? That's showing 11.4% of GDP as the gross tax revenue at the central level. This is a high for the last 10, 15 years. The last time we saw such a number was 2008, where we saw about 12% of GDP. So it's a great sign. Okay. Why is this coming up? It's because we've seen more formalization. The amount of payments going through the formal channels, UPI or NEFT, RTGS, IMPS has definitely gone up. So all of that formalization, the big companies doing well, is reflecting in higher tax collections. Okay, and that trend should continue. For the next year, I think we've penciled in 27.5 lakh crores of gross tax income. I think that's way, way low in terms of the actual numbers that will pan out. I wouldn't be surprised if we actually collect 3 lakh crores more than budgeted, which is more than 1% of GDP. That gives a lot of room for the current difficult situation that India is in. So you can allow for more food subsidies, more fertilizer subsidies. You can cut fuel taxes if required. So it does give the fiscal authority some room to play around with, and that's good news. On the overall borrowing program, likewise, I think, while RBI has made some very hawkish statements in April, along with MPC, I don't think they will abandon the bond markets. I think they will make sure that the borrowing program goes through smoothly. So while right now the markets are very nervous, of course, it's been choppy, but it's been broadly nervous. And as I said, the markets are factoring in a sharp rate, hike in 10-year bond yields as well over the next 1 year. I think it will cap at about 7.5 or so. I don't think the bond yields will go beyond that. Within that, issuances, etc., I wouldn't be surprised if the borrowing program eventually is actually lower than what has been budgeted. So they will probably bring down the size of the borrowing program. To that extent, this year, I'm not so worried about bond markets and yields, unless oil prices shoot up to $150 or something. Then it's a totally different new syllabus. We have to rethink the whole numbers.
Right. And my last question, Ananth, coming to you is with regards to the FY22 fiscal deficit as well. Clearly, yes, there will be a divestment shortfall that would be coming in, especially with the LIC divestment being pushed back. Do you think that fiscal deficit could remain in that range of 7 to 7.1% of GDP against that revised estimate of 6.9% of GDP, which I mean, that's the number that I'm looking at. But what's the sense that over there? Because clearly, if you go to see on the expenditure front as well, our capital expenditure has remained flat. Revenue expenditure has seen a pickup. However, again, from March 22 onwards, there was an anticipation that capital expenditure would start to see a pickup. So how is that roadmap looking like?
Sure. So for FY22, Hiral, I actually think the fiscal deficit final number, will be lower than the revised estimates, not higher.
Okay.
So they've penciled in 6.9, right? I wouldn't be surprised if it comes at 6.6 or 6.5 even. Okay. The reason for that is the following. One, you're right, disinvestment didn't happen. But the tax collections of the normal channels, your indirect and direct taxes, you keep seeing these flashes on newspapers of quoting sources saying that they're at record high levels, right? So it looks like the total gross tax collections and the amount which comes to the center is going to be far in excess of the revised estimates, more than making up for that shortfall of the disinvestment of LIC, which didn't happen. So that's point number one. Second thing is the mathematical jugglery. You know, the budget had put in about 232 lakh crores as the GDP of the country for FY22. The revised numbers which have come in from NSO are 236 lakh crores. So your denominator that you divide by to arrive at the percentage of GDP actually has gone up. And that therefore brings down your fiscal deficit as a percentage of GDP. I think that's going to be there as well. Third, as you rightly point out, it's not very clear if the entire spending will go through as planned, particularly in the capital expenditure side. I think they will try and push through as much as they can, but to the extent some has to go to the states for them to spend, that might not come through. So FY22 also, I expect that the fiscal deficit numbers might actually surprise on the better side rather than on the worse side. And that's the reason why I still have confidence about the FY23 fiscal deficit as well. I think there is room and buffers available to the government at that score.
Right. And lastly, Ananth, with all of this said and done, what according to you should be the key monitorables from here on to understand where we are going?
So one set of monitorables clearly, Hiral, is to do with the external context, which unfortunately we have no control over, right? Yeah. What happens in the geopolitics, what happens to commodity prices, what happens to the Federal Reserve? Are they going to hike by 75 basis points in one particular meeting? We don't know. So all those imponderables are there, which unfortunately we can't control. As far as what we can control, I wouldn't worry too much about monetary policy and fiscal policy. These are stuff that you and I like to speak about, and lots of analysts like to speak about, a lot. Finally, I think what matters is how successful are we in creating jobs, in creating output, and in increasing our exports. Now, the government does have a plan there, and we talked about it: infrastructure investments, ease of doing business, PLI, your disinvestments and privatization, and sectoral reforms like your financial sector and your mining sector and so on, and the power sector, etc. We have to make progress on that. If we make progress on that as a country, given the current global context where people want to invest outside of China, the China plus one, feeling which is there, I think India stands to benefit a lot. When I speak to global investors, the mood is very, very positive towards India. It is astonishingly positive. In fact, they look at me and say, boss, you're being too pessimistic about India. We are looking at other countries like Turkey and Brazil and China even now, and you look great, right? So I think we have to milk that a lot. And I'm hoping that those things which are in our control, which is not to do with monetary policy, fiscal policy, but really the government and the industry coming together to make things happen. That I think is the key deliverable and monitorable really for the country over the next 3-4 years.
Absolutely. So a lot of factors that need to be considered as well. Let's see what direction we take as well. Thank you, Ananth, so much for joining us on the show. Always a pleasure to speak to you and get insights. Thank you. Stay safe and speak to you soon again.
Likewise, and look forward. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.